Hello, and thank you for joining this short video on reviewing financial statements and how to get the most out of this activity in your business. First of all, why is this so important? Well, financial statements provide you with some kind of scorecard. They tell you how your business has been performing, and they also provide you with information which can help you to make smarter decisions for the future of your business. So let's take a look at some things you may want to consider when you review the financial statements of your business. First of all, financial statements must be read in the context of your business. That means the business conditions. It could be the economic conditions. Perhaps your industry is on an upward trend. Perhaps your business is distressed, or maybe it's booming. But we have to think about the surrounding facts before we launch into detailed analysis of the financial statements. Think also about the goals that you've set and the plans that you've made. This is really important, and it may be worthwhile to restate this context prior to launching into your analysis. Now, financial statements provide you with a sense of your business at a point in time on a particular day. But what we're really interested in is the trends. It could be how we've done year to date, over a 3-month, 6-month, or even 1-year period, because it's that which teaches us the direction that our business is going in. And most of the modern software programs allow you to quickly understand the trends across a whole lot of variables in your business. Another thing we want to look for is variances from the budgets or the forecasts that we've previously made. Perhaps at the beginning of this year, you made some forecasts, and those were based on your assumptions or perhaps your best guess of what was going to happen in the market. No doubt some of those things came true, but some of them didn't come true. And if we identify what those variances are, it challenges our assumptions and it helps us to make better business assumptions for the future. Now, an important part of the financial statements is the sales data. This really gives us deep insight into how your customers are behaving. Is the number of customers growing? Are they spending more with you? Are you keeping them for a longer period of time? This kind of information is absolutely critical because, after all, sales is the lifeblood of your business. And if sales is the lifeblood, cash is the blood which flows through the veins of your business. Without cash, it's very difficult for your business to succeed. So we want to get a really detailed sense of where we're going to be with cash in the future. And that requires us to take in both operating expenses, but also extraordinary expenses and tax payments we may have to make. Perhaps your business will require additional funds from a lender or an equity investor, and we have to model that very carefully as we forecast cash flow. It's all very well to be selling successfully in your business, but if you're not collecting the money, then we have a different problem. So the accounts receivable analysis will help you to understand the rate at which you're collecting the money. But maybe you have some accounts receivable which really needs to be written off. We want clear visibility into this. Now, over time, your business will enter into a variety of agreements, loan agreements, lease agreements, partnership agreements, and so on. We really want to understand the terms of those agreements and any future commitments that we may have, especially those which might affect our cash flow. So let's look carefully at these when we are reviewing our financial statements. Every business depends on its team for its success. If the team is motivated and driven and capable and competent, then we have a good chance of succeeding in our business. So the financial statements provide you some insight in this. For example, how much are we paying people and what return are we getting on our investment in our human resources? That's the employee return on investment. But we may find that we're turning over employees very quickly. That means low retention. We may be in disputes or potential disputes, which are going to cost us a lot of money. Some of this information is contained in the financial statements, and we want to highlight that. One of the best measures of the success of management in a business is whether the valuation, the enterprise value of your business has in fact grown. That's one way to validate the direction that the management team is taking the business. And it's best to get an independent view on this, because sometimes managers will be biased as they view the valuation of the business. We can learn more about valuation by studying the financial statements, and we should do that from time to time. Finally, reviewing the financial statements is not an occasional pastime. It's something that you do regularly, and you do it rigorously with a certain schedule and agenda. And it should generate some kind of follow-up items, and you make sure that you do follow up as required. This is the kind of rigor that should be given to reviewing the financial statements. We hope that's useful to you, and you will get more value when reviewing your financial statements going forward. And we do hope that you'll join some of our future videos. Thanks and bye.